Hey there! Have you ever thought about what a bank actually does with your money? Most people imagine banks as giant money warehouses. You deposit your cash, they keep it safe, and you even earn interest. Now you might wonder, how do banks make money from storing cash? Well, banks don't just store money. They can create new money simply by issuing loans. No printing machine, no physical cash, just numbers typed into someone's account. It sounds ridiculous, but this system is the foundation of how modern economies work. So in this video, we're going to break down the misconceptions most people have about banks, whether banks can create unlimited money, how banks make and lose money, why this system exists, and what can go wrong when it gets out of control. Let's get started. Section 1. The misconception. When most people imagine how banks work, they picture something very simple. You deposit your money, the bank stores it safely in a big storage box, and when someone else needs a loan, the bank takes part of your deposit and lends it to them. It feels logical. This old story is often linked to the idea of fractional reserve banking, but it is not an accurate description of how banks actually work. So, the word fractional means only part, and reserve means the special money that banks use to pay each other. For example, when you transfer money from Bank A to Bank B using an ATM or mobile banking, Bank A must send reserve money to Bank B. This reserve money is not cash you can hold. It's a digital balance that only banks and the central bank use. In some systems, physical cash in the vault may count as reserves, but to keep things simple, we'll focus only on central bank reserves. It cannot be used directly for loans, and it never leaves the banking system. Its job is to settle payments between banks. And remember, reserves are money from the central bank for commercial banks, not from your deposits. If banks need reserves, they get them from the central bank or from other banks, not from your deposits. So, fractional reserve banking means a system where banks don't need to hold 100 reserves compared to total deposits. Wait, hold on. What does it mean? Don't worry, we will explain it clearly. For example, let's say there is a bank named WeWe Bank, and there are 10 people who each want to deposit $1,000 into WeWe Bank. Now, WeWe Bank has $10,000 in deposits. Great. Then let's say WeWe Bank has $1,000 in reserves, which came from central bank lending or transactions with other banks. Now let's say there is a person named Bob who wants to borrow $1,000 from WeWe Bank. If the rule says the bank must hold 10 reserves against total deposits, it means WeWe Bank, with $10,000 in deposits, must hold at least $1,000 in reserves. Since WeWe Bank has $1,000 in reserves, it meets the requirement and can lend $1,000 to Bob. When WeWe Bank lends $1,000 to Bob, it simply types the number into Bob's account. Bob gets a $1,000 loan, and WeWe Bank now has $11,000 in total deposits. The original $10,000 plus Bob's $1,000 loan, which counts as a new deposit. Meanwhile, the bank's reserves in this scenario are still $1,000. Now let's say there is another borrower named Lisa who also wants to borrow money. But this time, the bank cannot lend because it still has only $1,000 in reserves, which is less than the 10% requirement, for $11,000 in deposits, or $1,100. In the past, banks were required to hold a certain percentage of reserves, such as 10%. But today, modern banks are no longer required to keep a fixed percentage of deposits before they lend. This is important because many people still think this percentage rule exists. In many countries, including the United States, the reserve requirement is now 0%. So that's why many people keep saying banks can create money from thin air. Section 2. Can banks create unlimited money? Now, if banks can create loan money from thin air, does that mean they can create unlimited money? Not that easy. When someone gets a loan, they eventually spend that money. Maybe they withdraw some cash, or maybe they transfer it to someone in another bank. For example, continuing our story, WeWe Bank now has $11,000 in total deposits and $1,000 in reserves, and Bob still has his $1,000 loan. Now, if Bob withdraws $300 in cash, WeWe Bank must use its vault cash to give him the $300. If Bob then transfers $700 to his landlord in Bank ABC, WeWe Bank must send $700 of its reserves to Bank ABC. So even though banks can create new deposits when they lend, they cannot lend unlimited money because they still need enough cash and reserves to handle what their customers do with the money. Section 3. How banks make and lose money. So, how do banks make money then? Well, first, of course, from interest. Continuing from the previous example, when Bob repays his $1,000 loan with $200 in interest, the bank earns $200 as profit. Wait, didn't the bank create loan money from thin air? So should the bank get the full $1,200 as profit? Well, remember, Bob already withdrew $300, which reduced the bank's deposits and its cash, and transferred $700, which moved reserves out of the bank earlier. So, the bank already lost that $1,000 earlier, and now gets it back plus interest, which means it only keeps the interest as profit. Apart from loan interest, banks also buy safe assets like government bonds to earn extra profit, which means not all of their cash is just sitting there doing nothing. Now, what if Bob can't repay his loan? In that case, the bank loses the amount Bob already spent, which must be covered using its capital, cash, or reserves. So even though it sounds like unlimited money, banks still need real cash, reserves, and capital to operate. Section 4. Why the system exists. At this point, you might wonder why we even use a system where banks create money. It might feel strange, but it actually exists for a not-so-subscriber, bar. Sing reason. Modern economies need credit to grow faster. Many businesses take loans to expand faster. Some people need mortgages to buy homes. And governments also borrow money. With this system, banks can lend money faster and in larger amounts, without waiting for savings to grow first. Could we do all of this without borrowing? Of course we can, but it would be much slower because everyone would need to save money first. But this system also comes with real risks. If banks lend too much, money floods into the economy and can push prices up, especially in areas like housing or financial markets. That is how bubbles form. And if lending gets excessive, the bank itself becomes weaker even though deposits grow. As I mentioned before, most borrowers will withdraw cash or transfer the money to other banks. This reduces the bank's vault cash and drains its reserves. When reserves and cash get too low, the bank cannot move money around as freely to settle payments. When many customers try to withdraw or transfer money at the same time and the bank cannot meet the demand, this becomes a bank run, and the bank can collapse. When one bank goes bankrupt, people panic that their money in other banks might get frozen too. So, they rush to withdraw their savings at the same time. When this happens, governments or central banks may limit how much people can withdraw per day, or even declare a so-called bank holiday, meaning banks are temporarily closed to prevent panic withdrawals. But if this happens, it often makes people panic even more and creates a chain reaction of bank runs that can crash the entire economy, similar to what happened in the US during the Great Depression. Section 5. The real limits on money creation. As mentioned earlier, traditional percentage-based reserve rules are no longer the main limit on lending in modern banking. In places like the United States, the reserve requirement is now 0%, so banks are not required to keep a fixed amount of deposits before lending. But this does not mean banks can lend without limit. The real limit today is capital and liquidity. So, what do these mean? Well, capital is simply the bank's own money. The money that comes from the bank's owners and shareholders. If the bank has many unpaid loans and starts losing its cash because borrowers have already spent the money, then the bank must use its own capital to cover those losses. So, banks still need enough capital to absorb losses and avoid failing. But won't banks take over pledged assets to cover losses? Yes. However, those assets can be illiquid, meaning they're hard to sell, like houses. So, capital acts as a quick way to cover losses temporarily. Then there is liquidity. Liquidity means how easily the bank can move money in and out, like how water flows smoothly. Even though loans create deposits, the bank still needs enough cash or reserves to pay when customers withdraw money or send it to other banks. If liquidity becomes too low, the bank must slow down lending, or it can end up facing a bank run. That is why, even though banks can technically create loan money, they are still very strict about who gets approved. This is because their cash, reserves, and capital are limited and difficult to replace quickly. So, in conclusion, banks do not simply lend out your savings. They create new money when they issue a loan, and then use reserves for transfers to other banks or cash to meet withdrawals. This cycle of money growing and shrinking is what influences how the modern economy works today. And that is why when banks start collapsing, the entire economy can collapse along with them. So, the next time you hear people say banks can make unlimited money out of thin air, you now know it is not that simple. Help us keep making videos like this by becoming a member and unlocking some exclusive perks too. If you want me to make other videos explaining these topics, please like and subscribe. Thanks for watching.